oil is spiking. We all know why, right? The Strait of Hormuz is effectively closed. Essentially what that means is that it's too dangerous for the ships to traverse that area of the water, and insurance becomes a problem, of course. So basically it is clogged up there. It's not like, Iran literally has ships there. I don't think they have any ships left. But that's essentially what's going on. And as long as that lasts, of course, oil is going to stay high. But as soon as the problem is resolved, of course, there's going to be an initial piece of good news. Oil will come back down. I don't think it'll crater completely, of course. It takes a little while, and it can be a little sticky in those high levels. But of course, it will be significantly lower. Now, when that happens, we don't know. That's the point of option trading. So what I like to do is just get a general gauge of what I'm trying to trade, what profit range is, and then, of course, what are the potential downsides if I'm completely wrong. We're going to be looking at the USO, essentially an oil fund. You can see it got pretty high. It is still quite high. Anytime something goes parabolic like this, like it did with, say, silver and gold, anytime you see this, of course, an option trader, it's best if you target extremes, right? It's actually down in this range. It would probably be more suitable for iron condors, steady, week to week, month to month, just adding layers over and over. But anytime you get something that's really extreme, that's when option traders will target something to say, okay, well, more than likely it's not going to stay this high for very long, and we have to capitalize on it. This is a 2-year chart. We can even go a little bit shorter than this, but we can see that under normal conditions, it was bouncing around sort of in the 80 range on the high end to basically 65, 70. I think it's perfectly reasonable to think that 75 to 80 is kind of the baseline. Now, whenever you get something that's a real scare like this, like I said, it can be a little bit sticky. It would be rather odd if it crashed all the way down and hit below 70. That would be a little bit surprising, in my opinion. So what you actually have to do is target where you're trying to set up your trade profit window. And for me, I would say more realistically around 100 or so. That's where I would say if you could set that range, it's not super likely to go below 80. It's really unlikely to stay above 100 unless the crisis continues for months, which of course it could. Again, that's what options trading is for. The second range is if this just lasts a really long time. You could end up with a situation where, yes, whatever it's doing now, it could actually stay there. And then the third little thing I'll draw on here is, of course, it's always possible that it's just a real shock and we get something that's actually even lower than where we began. I don't see this as very likely. It's kind of like the volatility thing where if the VIX spikes to 40 or 50, yes, it's obviously going to come down, but it's difficult to get back within a few months to where it was before. That typically doesn't happen. So essentially, we're looking about 80 to 100. And then the fourth one, the one I mainly wanted to talk about, is broken wing butterflies. So when we do a broken wing butterfly, first I want to start with a butterfly. And I want to show you that. For people who haven't seen these before, hopefully prepare to get excited. So 90 to 105, we'll say, just a 15 strike gap, and 75. So a normal butterfly will look like this. It is essentially 2 center strikes and then wings on either side. Now this trade right here, there's nothing wrong with this specific trade. You can see the price today is right here. So if you were to open it and nothing happens and the USO stays high, this trade will lose 310. Let's scale this right now, 620. But of course, I am expecting it to go down. And what did I say I was expecting? Somewhere around 80 on the low side and 100 on the high side. You can see the break evens are at 78, so that qualifies. And the other break even is at 102, so that qualifies. This is basically the exact range that I'm targeting, right? So all I need is the USO to normalize. And you can see here, you can make a lot more than you actually pay. This is a debit, so I'm paying about $614 for 2 contracts. You can see if you nailed it right at the peak, which is never going to happen, but you can see I could make, I keep saying you'll see, if you look right here when I hover it, it says 2,328. That's how much you can make if you just pinned it at the top. But in order to double the money, 614, it really only has to go, say, there to about there, right? That's a pretty good range, right? When you're talking about a trade, I basically said 81 to 99. That is my exact range, and you could double your money. or more. So this right on its own, I would say that that is actually the best trade looking at it right now. However, there is something else that we can do. So first of all, the broken wing butterfly, basically you're just cutting off one of the wings depending on which side of the trade you're expecting. So butterflies are fine. It's basically like an iron condor. They're totally fine, just that trade. But what the broken wing butterfly allows you to do is apply a little bit of your opinion on direction on top of it. So if you're the type of person that says, odds are favorite, USO is going to go down. But I think it's going to happen soon, and I think it's basically guaranteed. I don't think USO is going to stay high for very long. That person can break one of the wings and favor that side. Another person might say, I'm pretty sure it's going to go down, but if it doesn't, I could see this maybe lasting a month or two. And in that case, I don't want to lose very much if it stays high. So the first person, he says, it's going down and I'm not scared of it staying high. That person could maybe go to the 110 strike right here, and you can see what happened. I basically just traded some of the risk here and I put it all the way over here. So now anything below 104 is going to be just fine. Big profit range. It's the same profit range as before, ratio-wise. And then all the way over here, almost no loss. So this person is the guy who thinks USO is going down. I don't really see much possibility it's over 100 2 months from now. The other person might say, well, actually, I have reason to believe that the strait might be closed for a while. And so I don't want to be totally killed if that's the case. Well, then you can break it here. You can see this person would lose 500. And they could potentially make 2,400. But if they're totally wrong, they could lose 1,500. So they basically just put 500 from here and put it over there. Or you could even, if you wanted, you could do more. You could do something like that. And then you could flatline the top, no risk at all here, and then down. This is for the person who thinks USO could very likely stay high for a very long time. But something like this is fine. So when you're doing the broken wing butterfly, essentially, you are just skewing the trade a little bit. You don't want to take it like a vertical, as I showed you, a vertical and a put option. They're entirely directional. You basically have to be right to make your money. The butterfly allows you to, A, get a market neutral style trade, but also skew it a little bit. And we are doing it from the perspective, remember, I'm going to switch to the Vega again. We don't want to be long Vega. That's the problem, is that when USO goes from 120 to back to 100 or below, volatility is going to collapse. We don't want a trade that's going to collapse with it, obviously. So this is actually negative Vega. As it goes down, you're going to make your profit quicker. So that allows you to actually get out of the trade a little sooner if you wanted to. And the last thing that I will say, just let's scale this correctly. So we need one of these. And that would be risking 730. So that's risking the same as the put option. So you can look at this trade. Vega negative, huge profit range, can way more than double the profit, and it can break even above 100. Versus what most people are going to do this week, today and next week, what most people are doing is this. They're basically just taking a pure put option directional play. They're super short, they're long Vega, which is going to kill them. And the USO has to go quite low in order to make a decent amount of money. So I would say vertical's fine, but certainly the broken wing butterfly is where my money would be. I would rank them kind of like this. Long put options and no, absolute, do not do it. It's just a dumb trade. Long put vertical, I say it's just better than the short call vertical, but put that second. And then the broken wing butterfly, not only is it way cooler and way more fun, but this is actually a great range. And like I said, you can skew it how you think. So for me personally, I definitely think yellow is more likely than red. For me, I just don't see how this situation can persist for very much longer. It is, I don't have any insider information on how weakened Iran is. I don't know how long they can sustain this for, but it just seems to me that we are talking about the US and Israel. They are significantly more powerful, and it's been 2 weeks already. I'll bet in another 2 weeks, the landscape changes pretty significantly. So I definitely think going down a little too far would be my concern. Below 80, I think is more likely than staying above 100. So for me personally, you'd be talking about, I am the other guy. Remember? I'm this guy that, let me find the 110. I'm this person. I really don't think it's going to stay up here. And I think that it's not likely, but certainly possible that it crashes below 75. So I would be looking to do this trade here. Break evens are super wide. That's my entire green range. The whole green range is covered. And we're right here. So let's scale this. That's the last little piece of the information. Typically speaking, so I have an option strategy that I call directional flies. And for my directional flies, it is usually 1% trades. I just layer a whole bunch of them anytime I feel like it, basically. Any underlying, anything that I'm looking at, any stock, any precious metal or commodity, I just take the market neutral trade, because most of the time you don't want to be too directional, and then just skew it a little bit to the side you like, right? Maybe you're trading gold and you think, okay, I'll take a butterfly on gold, market neutral, but I think it's more likely to go down rather than up. So you would just skew it a little bit. But I just layer over and over and over. But when you get a situation where it's such an extreme position, and like silver was a few weeks ago when I did that live stream, and we actually live traded that silver trade, it's the same thing. It's such a parabolic move. You don't get them very often. So I typically feel very comfortable ramping up my allocation size. So I can basically risk 2% of my overall portfolio. But what I also like to do is I do like to use stop losses. So for this strategy specifically, over here, I'm not going to allow it to go more than 50% down, but I am willing to lose 2%. So this is just our account that tracks our live trades for VTS, but I'm going to scale it to this. So grab my phone, get the calculator out, 139,000, give or take, times 4% of the account is 5,500. So first of all, that's how much I can lose. I can risk that. Let me see if I can get one more here. 53. Yeah, that's perfect. 9 contracts puts me, if I waited to the very end and USO was still this high 2 months from now, I'd lose 5,400. But like I said, I'm going to use a 50% stop loss. So I'm actually only going to lose the 2% maximum. But this also means that if the USA goes down quickly, I can actually probably cash out on that trade because the Vega is not going to hurt me at all. So I could probably close this out for a much larger profit if I'm right fairly quickly. Like within a couple of weeks, this could very well be right in the range. And then I'm going to have a decision to make. Should I close it out and take the money, or should I let it sit there for a while? But no matter what, I will not let it lose more than 50%, right? If I'm totally wrong and I continue to be wrong week in and week out, there's really no point pushing it that far. It's actually beneficial to get more money into the trade using a stop loss than it is to just do the baseline, because 2-3 weeks from now, that decision is going to be more profitable. It just gives me the choice of making more money. So this is exactly what I would do for this size of account. Whatever size of account you're trading, I think fairly comfortably I can say risking 4% on a totally parabolic move in oil, given that this will probably be resolved in a few weeks, maybe 5-6 weeks at most, 50% stop loss, I'm pretty comfortable putting 2% on the line here. So this is what I would do. That's my trade. So if anybody, this is not investment advice. I should have put one of those disclaimers like, consult your financial expert. This is not trading advice. Don't do this, all the disclaimers. But basically, this is what I'm going to do. And there's nothing wrong with me sharing some trades with the community. So these are outside what we do at VTS. But this is an opportunity to just put, like I said, 2% of my capital at work, even though it's 4 technically, and possibly make 3, 4, 5% on that 2%. So that's basically what I'm looking for. You don't want to swing for the fences. Every single year, there's going to be these types of parabolic moves, not in oil specifically, but there was one in silver a few months ago. There's going to be some in stocks. Sometimes they go way too high and you just think this is insane. Sometimes it goes way too low. There's always opportunities. So when you see this, you don't have to put like 20% of your account on the line. I just think a nice 2% trade 5, 6, 8 times a year, and it can really add up. So that's what I'm doing. Feel free to do it as well. I'm not going to take the trade right now because I think that would be probably jumping ahead. If it's not like a whole bunch of people are watching me or anything, I'm not overly popular, but I just don't want to be accused of front running anything. So feel free, go in there. You can do it before I did. And after the live stream, I'm going to jump in there and do that trade. Here we go. Let's just actually see if we can get how much is the market moving around. Sometimes when the market's moving a lot, getting option fills can be trickier, right? It sometimes when you're looking at the pricing here, it's not the exact pricing always, and that can frustrate people. They're like, well, what's going on? It says 603 and I can't get that price. Sometimes that happens. That's just a display issue. These are computers matching up contracts, so you get what you get, right? You don't get your trade based on what your software shows. You get the trade based on what the actual tradable market is getting. Your software may not show you that completely accurate mid-price. But the S&P was up almost 1%, probably an hour ago, and now it's down 0.4. So I wonder, let's try to do USO, broken wing butterfly, 9 contracts. So let's see. First of all, we're doing the May one. We're doing the 90 strike, broken wing butterfly. There we go. And I'm going to change this to 110. I'm going to change this to 75. I'm going to change this to 9. And we're going to see. So it's saying the mid at 598. So typically what I will say, 30-second rule with options fill prices, you don't want to sit here on your computer all day long. You basically, again, these are computers. They're very fast. They're very efficient. So what I would do is you always try to get a little bit better than you're expecting. And then you wait a little bit. Wait 30 seconds, right? I should have called it the 20-second rule because I typically only wait about 15 or 20. But the 30-second rule. And then you just bump up the prices every 20 or 30 seconds until you get it. So this is a debit spread, which means I'm paying money to open it. It's not a credit. I'm not receiving. So of course I want to pay as little as possible. So 586, maybe 583. See if I get that. The security is considered hard to borrow. Well, that's going to make this trade stupid, isn't it? If the order results in a short position due to assignment, a borrow fee may be charged. I don't care what you're talking about. Okay, so we will just go here and see. Again, this doesn't necessarily mean that's the pricing. This just means this is what my software is showing. And in my experience, toss midpoint is very accurate. There's been very few times that I find the toss is just way off. So I would essentially wait. It's a live stream, so I'm not going to, there we go. I was going to say, I'm not going to wait. I would have bumped it up to like 584 or 585 and just try again. But as it turns out, I got my trade. So now I can just highlight my live trade. And here we go. From there to there, current price is here. And here we go. So I am risking 52.47, and I am potentially making as much as 12,700. If USO, I keep saying USA. If it craters completely, we're talking about losing 747. But remember, I did say that I'm going to use a 50% stop loss. So I'm not going to let this go past a $2,600 loss. If I'm down $2,600 at any time in the next 2 months, the trade is done. It is closed. What I suspect is going to happen is the price is going to start going down maybe soon, maybe not for a few weeks, but eventually I'm expecting the price to start bleeding down, especially since the Greeks are kind of on my side. Theta, we don't really worry about on directional trade so much. Delta is definitely on my side, of course. And then the Vega is on my side as well. It's not going to be crushing if volatility goes down. So the chances are pretty good that I'll be able to close this thing out, relatively soon, well before the 200 or the 2 months. But that's the trade. Pretty easy stuff. I love broken wing butterflies. They are essentially, what would you say? It's like the Swiss Army knife of option trading. There's very few times that a broken wing butterfly isn't the right trade to put on. Like, again, you can do verticals because there's a put and there's a long and a short, so it's fine. You can do iron condors, but you're using 4 strikes instead of 3. Sometimes I just like broken wing butterflies simply because if you're talking about SPY, no problem. You can do a 4-leg iron condor and you can do a broken leg iron condor, broken wing iron condor, no problem. But when you're dealing with things like VIX options, when you're dealing with volatility ETFs that sometimes dip down in price into the teens, then you want to reduce the number of strikes you're using, which is why I basically almost always default to just broken wing butterfly. But that's the trade.